Silver has recently been much weaker than gold, starting to show turning signs for us as well. And I think that once gold crosses that threshold of 2,500 and suddenly people realize it wasn't a top, that's when the money flows start to get aggressive. And anybody who wanted to sell silver has probably already done it. They're either short or they're out, in which case, if you go back up, you're going to have a lot of short covering, and you're going to have a lot of guys who got out saying, gosh, I made a mistake. And I think that the wild dog will slingshot again, leading gold this time. Turned aggressively bullish again on gold, not that we were ever bearish. We turned bullish in 2016. Gold was 140. Our long-term view has never changed. There have been big sell-offs, we know that, but it's still a major trend. This pause that we've had since the April high in gold, when it got up to about 2450, you've eked out some marginally higher highs, but the price chart is to keep risking that 2,500 level. Now, again, we're talking the front month contract, so we're talking October gold, which is below 2,500. Everybody looks at D's gold, but October is the front traded contract. We'll rotate the December future in our analysis once we get into October, the delivery month. But that contract continues to be sold just short of 2,500. It actually isn't just a price level. We have momentum trigger levels that assert that the recent range action we've had in gold, which has been fairly benign, will start to explode again if you get much above 2,500. I've got a whole cluster of momentum-based structures that are breaking out there, not just the price going to a new high.
I've got a whole cluster of momentum-based structures breaking out, so it's for real. Once gold exceeds $2,500, expect acceleration. At that point, I'd expect the wild dog silver to suddenly do the opposite of what it's done recently. If you look at silver since the beginning of the year, for example, gold didn't peak, it stopped going up in mid-April. After mid-April, silver shot up another $2.03, making it much stronger than gold after the April high, while gold plateaued. Now, silver has recently been much weaker than gold, but is starting to show turning signs. I think that once gold crosses that threshold to $2,500 and people realize it wasn't the top, money flows will start to get aggressive. Anyone who wanted to sell silver has probably already done, so they're either short or out. In which case, if silver prices go back up, there will likely be a lot of short covering, and many who exited the market will realize they made a mistake. I think the wild dog silver will slingshot again, leading gold this time.
Well, by the way, watch the gold miners too. They're doing quite well. GDX has, if you'll look at it, it's been zigzagging upward while gold plateaued. The high, it'll back off pretty seriously. Never go, our original re-entry level on GDX was back in March at 3150. We said at that point it's going to accelerate. Well, it shot up to 37, backed off 38. And the recent highs have been 39. Right now we're in the mid 37s, I think. Okay.
Great
Coming
call.
back up. I've got some renewed trigger levels on GDX that say probably acceleration, dramatic acceleration in the advance. No longer this arm wrestling stuff. If you get up above 40 by just a bit, we get very specific in our reports, but it's just above 40. Now, the old high in GDX, again, the high back in 2020, the gold was already, 2,070 in price. GDX was 4650. Now, if you ever clear that, people are going to get excited, but I'm going to say this. If you get much above 40, you're going to clear that, and you're likely to clear it in a heartbeat and go zooming past it. In other words, I don't think it's resistance. I think we'll just go zipping through it. The trigger level's just above the recent highs. And, whether they do it before September or not, being an Iron Man that he is, he probably doesn't want to do that because it would look like he's spooked by something. I know what he's going to get spooked by the way, the banking sector, which is not having a good bounce, by the way. But forgetting that, we have the rally right now, and let's assume tomorrow is a good data point. There'll probably be more rally. If you see that rally peter out in the stock market, like, you get a good day tomorrow, then suddenly you close with a wobble, maybe up but off the high, and then next week you've got nothing. If you see that kind of response, then effectively what the market's done is it's priced in the rate cut. Now, if you go back to the top in 2000, 2001, and the top in 2007, circle when the Fed shifted from policy prior rate increases and then a pause, and then they cut, circle the point where they cut. And if you shorted then, you did quite well. The Fed cutting rates is not a good sign. There's a party going on. Now, at the same time, it's our view fundamentally, and we're technicians, of course, But gold is driven by monetary excess, which is an ongoing process, decade after decade. The monies degrade because they increase the money supply, they cut rates below what the market might otherwise, et cetera, et cetera. It's just a constant fuel. So a rate cut shift now for gold, positive, and it's not a failing rally. Just like in 2001, if you shorted the S&P and bought T-bonds and gold, you made money both sides. 2007, if you shorted that Fed rate cut in September 2007, the market peaked a month later. Gold and T-bonds continued up while the S&P went down. I think we're in the same position right now.
Just like in 2001, if you had shorted the S&P and bought T-bonds and gold, you made money on both sides. In 2007, when you shorted after the Fed rate cut in September, the market peaked a month later, while gold and T-bonds continued to rise as the S&P fell. I think we're in the same position now. Over the last year or two, T-bonds and gold were moving together, meaning price, not yield, but then they divorced themselves recently, with T-bonds remaining under pressure while gold surged since March. T-bonds tried to revisit their October 2022 lows, but couldn't do it, while gold broke out. So, to some extent, the linkage that we saw between them got divorced. But now they're back in sync because T-bonds, via our work using quarterly momentum measuring price versus, say, a 3-quarter moving average, broke through a massive basing action at the end of last month when T-bonds were around 120. Now, they're trading around 124-125, reaching up to 126. I think T-bonds have now shifted in a mega way, indicating their next significant move is up, with a drop in yields coinciding with gold's upward move, inversely to what the stock market has just recently done. The dollar index has been a non-event for well over a year, ever since it collapsed from that 115 high down into the 90s on the dollar index itself cash, and then oscillated in about a 7-8% range, trendless. And so, who cares, right? It wasn't influencing any market. A month ago, we started to break some long-term metrics just around the 104 level, just above 104. Now it's down to 102. If it closes a month at 102 or lower, expect the dollar's downside to accelerate. Suddenly, at that point, this other asset category money, specifically major currencies, comes into play. The dollar index is mostly the inverse of the euro and the yen combined. But if the dollar index breaks down about half a point below where it's trading right now and closes a month there or lower, expect the downside in the dollar to make some noise, in which case you have a new variable affecting other markets.